Hunter, before my partner gets excited, explain to him that it's not located at an obscure location in a desert with naked people running around. 'Cause he's going to register right away. So just give him realistic expectations.
Well, I've never been to one of those that focuses on raising money, but if there was one, I'd probably show up. But no, RaiseFest, it is in a desert, but it's in Phoenix. Let's go!
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the Professor Luigi Rosabianca. What's on tap today, Lou?
Matthew, a lot of small business owners like to dabble in real estate. Today, they're all going to pay very close attention because we're going to teach them how to play the real estate game well. And we're going to do it with the help of Hunter Thompson. Hunter Thompson is a capital raising expert and founder of raisingcapital.com. He's been helping investors master the art and science of predictably raising capital with this wonderful two-step holistic approach he's going to delve into very soon. More importantly, he's got this awesome podcast, highly recommended, Matt, Cash Flow Connections Real Estate Podcast, and also author of the #1 Amazon bestseller, Raising Capital for Real Estate. Mr. Thompson, Hunter, thank you so much for joining us on the podcast. We've been looking forward to this conversation for quite some time. How are you, pal?
Doing well. Thanks again for the opportunity.
Oh, are you kidding me? So let's start with your holistic approach. I think it'd be a good way to get a foundational setup on how you look at and assess real estate opportunities.
Well, I mean, the first thing I'll say is, look, the market cycle is really important to know and to understand and to basically be obsessed with. And so before I even get into my strategy and my structure and these types of things, you just got to be aware that you are participating in a market cycle if you're going to be a market participant. And so the reason I say that is that if you're not paying attention to the underlying economics, you can be blindsided by the market. And so my career started in the wake of 2008 when people that thought they were real estate investors didn't think that being a real estate investor included understanding economic implications, and they were completely blindsided. And so right now what I see is we had this massive run up post 2008. We had a post-COVID boom, which created, as you know, money printing and later inflation, which created the Fed being incentivized to raise interest rates faster than they've raised them in 40 years, which then created massive distress in the real estate market. And we are, and I don't mean widespread, I mean very specific, but very pronounced, 25 to 30% discounts in commercial real estate, which is historically significant. That's where we are in the market. Anytime you see 20+% reduction in peak pricing, which is what we currently see, it is one of those once every 20-year type of situations. And I'm here because I want to spread that message. It's very difficult to do the thing I do, raise money. But when it is difficult to raise money, it is the best time to do deals, because in raising the capital, you find out that you're going to be met with investor objections, hesitancy, people going through liquidity crunches, maybe capital calls of other deals. It's difficult, but that's why prices are down 20 to 30%. If it was easy to raise the money, prices would not be down at all. And so I know how this story goes because that's how the beginning of my career started. And I want people to participate, whatever that means for you. It doesn't need to be with me, obviously, but that's why I'm excited to do this conversation today, is that this is one of those opportunities, and it means that it's hard, which it means that you're buying right.
So are you giving us this analogy where the macroeconomic trends are this huge wave? This is surf. And no matter how big your boat is, it's going to get swallowed by that surf. So just batten down the hatches.
Basically, you have to tweak the knobs in a way that you act in the opposite of looking in the rearview mirror.
Okay.
In the sense of when people are most concerned, when people are most strapped for cash, when banks are most hesitant, that is generally the time to buy. When loan to values are low, when debt service coverage ratios are high, when valuations are down. These are all indications that it's a good time to buy. It's also an indication that it's a less risky time to buy. But you'll find is that it's the most difficult time to raise capital and do deals, because the reason that's happening it's not just people are fearful. That's what I thought in the beginning of my career. What's wrong with everybody? Don't you know? You should just buy low. It's like, well, guess what? It's not that easy, because even if they were 100% convicted that this was the correct time to buy, many of them can't get the liquidity or can't get the debt to do so. And that is what actually creates the market cycle, not just emotionality, which is
Sure.
what I've learned over the last 15 years of my career.
While we're on this initial foundational conversation, you could kind of deal us a couple of cards on the different asset classes that you've been exposed to over the years. Because one of the nice things about having a conversation with you is you've dealt with different asset classes, right? So kind of walk the audience through the pros and cons of multifamily and retail and triple net leases and et cetera, et cetera.
Sure. So, we were talking offline about how everyone has strengths and weaknesses. And so it's really good to know that. And I'm open about the things I've struggled with, because it helps people know that whatever it is, maybe it's the exact same thing they've struggled with, or maybe it's something else. It makes you realize that there's one person out there that was able to figure it out, that had that same weakness or even a weakness, because some people on the internet just talk like they're God, and you go, I can never do this because I'm not God. Well, my background is, I wanted to make my own rules of my life. And so I am basically unemployable. I didn't like the idea of being told what to do. If someone said, here are the rules, I would say, okay, is there a way around it? Or can I break it? Am I still going to be able to figure it out? And it was just, that's my natural personality. And so when 2008 happened and everyone was saying the real estate market's crashing, I was kind of thinking, maybe this is what everyone's been talking about that I respect, saying buy when blood is in the streets. Now, when I went to go look at how to create a real estate company, there's a standard playbook for that. It's way more well-known now, by the way, but at the time there still was. Go out and buy a small deal, and then buy a bigger deal, and then a bigger deal, and you'll grow a real estate portfolio. I didn't want to play that rule. I didn't want to play that game. I didn't want to buy a $50,000 house. I didn't want to rely on a property manager making $50 a month either. So what I tried to do was I tried to skip all of that and go directly into the world of syndications, buying $25 and $50 million deals. And the way I was able to do that was I just started networking, going to networking events where people were doing that. And rather than try to partner with a group that had $300 million under management, I figured out the ultimate skip the line skill, which is capital. If you can raise money, you don't got to convince anyone that you should be a partner, that you are trustworthy. You don't have to do very much at all. If you can actually show up with the money, you get a seat at the table. And so I found out there was an operator with $100 million of mobile home parks that was buying another $100 million of mobile home parks. And I said, if I do show up with $500,000, will you give my LLC, because I'm going to pool this money into an LLC, will you give my LLC a better deal than if these 15 or 20 investors had invested directly with you $50K or $100K? And the operator, the person kind of doing all this stuff, the person with the track record, the background, the access to debt financing, these types of things, said, sure, look, if you just show up on my doorstep with $500,000 and you're not asking for control rights or being a partner, or you get to tell us what to do, then sure, we'll give you economics that are 30% better than if you invested $50K. My plan at least was to go to those investors and to say, hey, listen, you can invest through my LLC into this deal, and the economics to you are going to be exactly the same as if you had gone direct. All I'm going to do is keep the delta that I just negotiated. Without going into too much detail, does that make sense just economically from a flow of funds standpoint?
Totally.
Okay. So that's what I thought as well. And so this allowed me, and I didn't know the term, but it is now called, and was called at the time, the fund of funds structure, which allowed me to potentially invest in any asset class under the sun, because I wasn't the operator. I just needed to find good operators and focus on raising the capital. Now, for people that know me or have read my book, you know that this is not so easy. So I went to go and present this to some friends and family, people that knew, liked, and trusted me and had the money and all the things that you would think of. And it fell flat. I mean, I promised the operator I was going to show up with $500,000. I came up a little bit short, like $500,000 short,
Well,
and
Hunter,
had to go.
with all due respect to you, and you're a real nice guy, but no liking and trusting to go get a beer is very different than no liking and trusting to give $500,000.
100%. And no like and trust. And what about their appetite, their interest, their
Yeah.
confidence in their ability to make a decision? I mean, these are all things that they don't tell you in the first time you learn to raise money. But I bombed it. I texted my wife. She was just a woman I was trying to impress at the time. Hey, I'm going to go, is it going to be $1 million, 2 million, 3 million? Okay, none million. How'd it go? Well, it couldn't gone worth 0 million, none. But I just didn't quit. And I kept working and kept talking to different people. And yes, that was my plan, but it didn't work. And I just kept getting punched in the mouth, and later I figured it out. And now I've raised $100 million and, indirectly helped people buy billions of dollars of real estate, directly bought hundreds of millions of dollars. And, I've done all of this by not chasing investors, not taking no for an answer, but building a platform designed for this. I went on a long-winded thing, but I just wanted to mention that's how I was able to get involved initially with once I figured it out, mobile home parks, self-storage, non-performing notes, performing notes, retail, office, industrial, because I would find people that were good at that thing and raise capital for their deals. And so that's the structure, at least, that got me to where I am today.
So at what point did you go from actually owning or investing to owning and operating? Where was that switch?
Pretty recently. I had the inkling that that's where I wanted to go. But in 2022, when the Fed raised rates, I saw this as the once a career type of opportunity. There's two things happening right now that never happened, including in 2008. You've got booming and robust economies, high employment, high income growth, high population growth, job growth. There's markets out there that are just ripping. And in fact, the markets that are most exploding are the ones that are most struggling with valuation reduction, because you could only buy deals, in multifamily at least, with floating rate debt in those markets. You had to use adjustable mortgages in the most compelling markets because they were the ones that were bid up so high that you had to take the interest rate risk to make the numbers pencil. And so we looked at the market and said, Phoenix, we're going all in. I moved here. My wife, who was pregnant at the time, now we have a 14-day-old, moved here with me. My partner moved here, and we're just drawing a 40-mile radius and buying the city. That doesn't have to be everyone's strategy, but that's my level of conviction.
For the audience, can you go back and can you explain the difference between most people are familiar with, getting a 30-year mortgage, but they're not familiar with how commercial mortgages work? So why don't we break that down so they have a better understanding of actually everything that's going on?
Sure. And I'll keep it brief, but I think it's important just because of, who your audience is. Typically, when you do any kind of real estate transaction, there's a down payment, and then the bank or something like a lending institution provides the rest of the purchase price, right? So if you buy a $100,000 house, you put down $30K, the lender gives you $70K, you buy the house. Same is true in commercial real estate, just with more zeros and sometimes more commas. We're going to buy a $20 million property. We're going to put down $7 million. We're going to get a $14 million loan or whatever. And we buy real estate like that. Now, the follow-up question, of course, is how do you get a $14 million loan? And there's two answers. One, sometimes it can be way easier to get a $14 million loan than a $100,000 loan. Two, this is where the concept of general partners and limited partners comes in. I am now the general partner. I am the one that has the credit, the background, the track record, the balance sheet to get a $14 million loan. My limited partner investors invest 50 grand, 250 grand, but they're not going on the loan. So I take the credit risk, the balance sheet risk, and that's how syndications work typically.
Yeah, but what about the terms? Commercial loans are not going out 30 years. They're more about 7 to 10 right now. And I think it's important we speak about that, because if you look at rates where they were 5 to 7 years ago, they're a lot lower than what they are today, right? So what tends to happen from my point of view, and what I think we're seeing right now, and please correct me here if I'm wrong, is you have a lot of people that have to refinance those notes at higher interest rates. And that's why there's a bigger discount to the market, because they have to unload those assets.
100%. And sorry for missing the question initially, but yeah, that's 100% right. In the world of commercial real estate, typically you've got 5-year terms, 7-year terms, and 10-year terms. That's standard. However, when the market was getting out of whack, especially post 2019, 2020, 2021, these new loan products start to become very popular. In particular, bridge debt with floating rate. So rather than be fixed in where your interest rate is locked for 5 years, you would have a 3-year term where the interest rate might start at 3.5%, but could rip and go up. And in some cases could double or more. So what's creating the stress, to your point, in a market like Phoenix, where you had to take that interest rate risk to make it, because if you could either buy a deal with 5% interest fixed for 5 years, or a deal that was 3.1% interest rate, the market was so hot, you had to take the 3.1% and take the interest rate risk in order to make the deal pencil, or you just couldn't buy. So what's happening now is that it's been 3 years, and the owner has now suffered from their interest rate doubling, which they didn't anticipate it would, and also their loan term is expiring. And so they either have to sell, or they have to do what's called a capital call, where a bunch of more money comes in to buy down the loan and extend the product. Some people can do it, some people can't, but it creates distress in the market. Now you got to sell in some cases, and we want to buy that thing. So people say, hey, isn't Phoenix going through massive distress? It's like, well, yeah, that's why my partner and I moved here.
No, I love it. So what is RaiseFest? Talk to me about RaiseFest.
So RaiseFest is an annual conference where we have people of all different backgrounds in the capital raising space, real estate, non-real estate, private equity, buying businesses, et cetera, come to talk about what's actually working in today's climate. And every year it's different. We did it for 3 years, and strategies, tactics, how to generate leads, all this stuff is an evolving conversation. And so that's just one of the ways we kind of talk to our clients. And you can learn more about that at raisingcapital.com if you're interested.
Hunter, before my partner gets excited, explain to him that it's not located at an obscure location in a desert with naked people running around. He's going to register right away. So just give him realistic expectations.
Well, I've never been to one of those that focuses on raising money, but if there was one, I'd probably show up. But no, RaiseFest, it is in a desert, but it's in Phoenix.
So, a lot of people always talk about they want to raise money. They don't know how to do it. How do they get started? People are afraid to go to their friends and their family to ask, what's some advice for people that are listening that just need to raise some money for their business, or people that, have an opportunity to buy a piece of real estate. They just don't have the capital right now. What's your best advice for them?
I'll give you an answer, but I mean, I gotta call anyone listening. I gotta call you out, because what I'm about to say is probably something you've heard before. And at a certain point, like, listen, if you're enjoying the show, like, look, I enjoyed this conversation. If I had an extra comma in my bank account, I'd be doing this exact interview right now. I know both of you enjoy this stuff, because if not, you would quit. Who cares?
Correct.
But we're here to try to change people's lives. We want you to actually take action. I'm not here for the jokes and the story about me bombing in my first capital. I want you to do what I'm about to say. And if you do, I want you to tell me about it, right? So here's what I would do right now. I've worked on this for years. I found kind of the path of least resistance is the following script. I would text pretty much everyone in your phone, if you have their number, hey, I know it's been a while. Well, you can preface it by saying this, whatever. Let me restate this. I would say, hey, you can personalize it. I know it's been a while since we talked. If it hasn't been a while, you can remove that. But I've been heads down in the real estate or buying businesses, or I've got this new app, or whatever your pitch is. And there's nothing really available right now, but would you be interested in staying in the loop if I did have something available? When they say yes, escalate it to book a call and go through exactly what you're working on and try to get a soft reservation at that time, or a hard reservation. But I found that the first text message, you should literally say they can't invest with you. So it's like, hey, it's Hunter. It's been a while since we've connected, but over the last 15 years, I've been heads down in the world of real estate. I don't have anything under contract right now, but would you be interested in staying in the loop if and when I do? Question mark.
Hunter, you
The
really
answer is
are
almost always yes.
you really are calling us out, because Matt and I make a religion out of not contacting friends and family when deals come up, simply because, oh boy, why? I think if I have to psychoanalyze it, we probably come from very similar, close knit communities, and where, you see each other at the local watering hole, or you never want that deal that goes sideways. Well, Lou told me to do this, or Matt told me to do this, or your phone blows up because they didn't get their monthly report in time. So Matt and I just don't want to deal with that. So we've always gone the institutional route, or um, non-friends and family hybrid options. But maybe, Matt, maybe we're wrong, and maybe Hunter's onto something.
Listen, I managed a lot of money. I just didn't want to manage anybody else's money anymore. That's really what it comes down to. Because no matter what, if you really want freedom and you're taking people's money, right, you're answering to somebody at the end of the day. Okay, that's the way that I see it. But again, there is a lot of people in the networks that I'm in that come to me and say, "What are you working on?" I tell them, I don't take outside money. But the difference is there's always money moving. Money is always in motion. For me right now, I'm selling a property. I got to do a 1031 exchange. I need to put that money somewhere. So I'll probably reach out to Hunter or somebody else, or somebody. I might wind up doing a DST, but that's a whole different story. But I got to do some stuff. I got to make some moves. And people in our circles are always making moves. And the way that I actually look at it is maybe not so much with friends and family, but I have no problem offering opportunity to somebody else. It's up to them, as long as they know the risks involved.
Yeah. Yeah, I think that the reason I answered like that is based on, the question more about how can someone get started? To me, that is the answer, because it's like that's all you currently have. You can try to do what I just outlined, but it takes time to build up a reputation, a brand. If what I want for you to do, if you're just getting started, is to do that, because it'll give you reps. The truth of the matter is they probably won't invest, but it'll book your call filled with people. You'll start to hear responses, some objections. You'll have to hear questions that you wouldn't have thought about, but the risk is zero because it's your friends and family. They're not going to hate you. They're not going to sue you. They're probably not going to even invest with you. So the real risk, like when you're getting started with me, I had an empty calendar. That's a huge that's the worst problem, is no one wants your time. You know what I'm saying? Like that's a zero. So anything's better than zero, including doing calls with people that might not invest with you, because then you're just at least getting some momentum. Both of you have now gone way above and beyond that. You can kind of skip that stage through certain paths and these types of things. But look, the institutional route is something that I do as well, because deal volume is down so much. Since 2022, we haven't done an institutional deal. However, the last offer we submitted, this is a little bit of a flex, but it's also a little bit of an embarrassing story. There's a reason you had me on this show. There's a lot of reasons, right? I've raised $100 million. I scaled a company from 0 to 10 million in 31 months. I've done some dope stuff. And by the way, with most meetings I attend, dude, I'm the man. Right? I get to tell the jokes. People have to laugh at the jokes. If I don't like somebody, they get to be fired. I mean, I get to make that decision. That's how we run around these businesses. I say that to make fun of myself, because when we submitted this offer with this institution, I wasn't included in the offer because it's basically embarrassing. It's like, this group has done this. And here's little cute Hunter Thompson, who just in their last capital raise 2 months ago, they raised more than I've raised in my entire career. So you don't add, it would be like doing a disservice to me to be like, and this cute little guy, Hunter Thompson. So my point is, the institutional world can change your life, because you can meet a partnership with a group that has a pension fund and a $650 million equity investment, not assets under management. They have to deploy $650 million. It is worth hunting down those elephants, but it's a good idea from a business standpoint, I think, to get more momentum with retail investors, $50K, $200,000 investors, because it makes your life more predictable.
Listen, I absolutely love the retail world, and I think everybody should be in real estate. I mean, we do a lot on the business side more, but for me personally, I could speak of, when I invest in real estate, it's for cash flow and depreciation, right? Every medical practitioner out there should go out there and get their wives a real estate license and start doing court segregation to lower their taxes, and then invest that money through a syndication where you don't have the headache. I'm all for that all day long.
100%. Love that.
Hunter, what's your advice to the busy and active entrepreneur that is doing day-to-day operations, is looking for a little passive income, like Matt says, but also would be inclined to be a long-term hold prospect because he or she just doesn't have the time to invest in monitoring macroeconomic trends and cyclicality. So, like, where do you see a, a comfortable long-term hold?
Well, let me answer the question from a side hustle perspective.
Please.
Many of the people that we've helped, and I help people raise capital, build businesses similar to one that I've built, they have W-2 job, and they've found that raising money and that skill is so scalable that you can use it as a way to hybrid or even leave your W-2. Because if you can raise capital for other operators, they're doing the dirty work while you are working your job as a dentist, doctor, sales professional. You can follow where I'm going with that.
Yes.
And then are allowed then to defer to other people's expertise on doing things like tracking the market and making prudent investment decisions. Now, you get diversification if you do that. You can then be involved in self-storage, mobile home parks, multifamily. But in exchange for that diversification, you give up a bit of control. And so this is something that you should be taking seriously. Is this a good fit for your personality? Is it a good fit for your lifestyle? For many of the people that I've worked with, it's an excellent way to develop your network, make good money, and eventually, if you want to, leave your W-2 by focusing on the capital raising side of things. And then you should be able to have a conversation about anything you're raising capital for, obviously. But it doesn't need to be the case that you do 20 years of deals before you go and raise money for a self-storage deal. You can find someone who's extremely competent that has done deals for 20 years and to some degree defer to their expertise once you've conducted due diligence, not just on the deal, but on them as well.
Besides the hot Phoenix market, for you and your partners, where else have you identified nationally that could be an interesting opportunity moving forward?
So I will say that generally speaking, I'm a big believer in more prime markets and more prime opportunities. Tier 1 kind of opportunities and tier 1 markets. Now, this is a very significant evolution to where I started my career. But like I said, we all have different strengths and weaknesses. If I'm the kind of person that's going to go right when people are saying go left, that can lead you to do stuff that's not optimal because you find out there's a reason they were not doing that. I'll give you an example. Year 1 investor. Let's take you guys back to your first year, freshman year of being an investor, right? What's better, a 10 cap or a 6 cap? Well, a 10 cap, duh. That's kind of my attitude. Why don't I go to a place where you got to take 6 connecting flights to get to? Well, guess what? You can get a 13 cap at 25 minutes away from any major, like tiny little airport. There's a reason it's a 13 cap. There's no buyers and sellers and lenders and property managers. And if one thing sneezes in the market, you're not going to find any market participants.
It's not liquid. Yeah.
Exactly. That's another way of saying a very word salad that I just said. But what happens on the other side? You go to Tampa and you want to buy an A-class property, you're going to be in bed with sharks. There's going to be really competent players. So I have made the decision, I would much rather be with competent players where it's very competitive, where there is a lot of liquidity, than in tertiary markets. So what that means is I prefer multifamily, I prefer self-storage, I prefer some industrial, to things like now mobile home parks are more tertiary. 60 minutes outside of Greensville, North Carolina, that's more tertiary. You're going to get a higher yield, but you get my point. That's just my personal perspective. So I like to make sure, is this competitive? Is there a lot of market participants? If this property manager has to leave, who's the 2 and 3 and 4th option? Because that's what happens in business. What do you think about that? I mean, I'm curious, like in terms of your perspective on what I just outlined.
So I'm a little bit more in the Hunter camp. I've always looked at America as being an assembly of city-states. So I find there to be more comfort in Manhattan, Miami, Nashville, Atlanta, the Eastern Texas corridor. I feel more comfortable there. Having said that, you can't ignore politics and macroeconomics over the last decade or so, where regulations and taxes and just some places are no longer friendly. They're not business friendly, right? So look, I see the advantages that Matthew has living in Florida versus me living in New York. But I don't like his flood insurance, right? So it's it's like a small blanket. You cover your shoulders, but you expose your feet. You can't have everything, but yeah, you kind of have to fit in within your risk aversions.
For sure. And I think that if I could speak to my former self, it's impossible to acquire true wisdom in this space without living it. Like, it's impossible. And the reason I say that, maybe it's to protect myself, but just I got into this business with 100% confidence that I just saw the world clearer than everyone that was making mistakes. And it's just really hard to truly know unless you live it, right? So you can read Howard Marks's book on market cycles and you can actually memorize it. But until you see how it goes, you don't know how you're going to respond. You don't know what it's like to be in that position. You don't know what it's like to go through 2 years of deal volume being down by 80%. What does that do to your confidence, your conviction? What does that do to your balance sheet? What does that do to your mindset? What does that do to your family? So you just don't know, and you don't know how you're going to respond. But the point I wanted to make regarding what you just said is that if you're young in the space, and I don't mean young as a person, but young, you're in your first 5 years, you might see, dude, what's wrong with everybody? Shouldn't you all buy in Florida? And you think that you've uncovered this play that no one else has seen because it's a matter of hubris, but it's like, maybe in fact it's priced in. Maybe in fact, the fact that everyone knows that every October there's going to be hurricanes is priced into the fact. Maybe that's why you get a better deal going to Florida versus Phoenix. And so what I wanted to do is just kind of swipe that all aside. Not to say that big picture theses aren't valid. It's just that that is small compared to what actually matters, which is dedication to operations, knowing what you're doing, rinse and repeat, scalability, being an ethical actor in the space. Those are things that actually move the needle, not New York versus Florida, where in the past I could say, duh, Florida, and go there.
So with the rise of every internet real estate guru out there, right? Especially over the last, you were actually doing podcasting and you're almost 10 years in on everything, right? That you've been doing. So
yes.
You've been out there for a while, but it seems like everybody and their brother is saying, hey, send me money. I have real estate deals to do. What does the audience need to know on how to do their due diligence on these so-called, buy everything with no money down and you'll be a millionaire in 30 days?
Well, I can, maybe in the future I can come back and do just a full hour on due diligence, because that, of course, is how I built my career, right? Because I didn't talk about raising money until I had raised quite a bit, and I didn't raise any money until I'd done a lot of due diligence. So just to be fully transparent, I wrote my book in 2019, and right before I wrote it, I was contemplating whether I should write the book about that or write the book about due diligence. So this is something I took very seriously. But the thing that I would say is that when I started, I was optimizing for diversification versus focus. And that was a mistake that I wish I had not made. If I were to go back, I would, rather than look at deal specific due diligence and look almost exclusively like this, who are 5 people that I'd be willing to bet my career on? That's the due diligence lens. Is this person someone that I would bet my career on? And all your due diligence has to do with that. It doesn't mean, oh, do I like them as a gut feel perspective? Do I enjoy going to the movies with them? I mean, as you go through underwriting, as you tour the property, as you meet the property manager and see how they interact with the property manager, the lens is, would I bet my career on this person? Because if you invest with them, it's one thing, but if you raise capital, it's a totally different thing. AKA, you are in fact betting your career on that person. So I like that as the best. I can list off like due diligence checklist items, but they're all irrelevant, because if you buy a perfect property in Beverly Hills that's 100% occupied and the operator commits fraud, everyone's losing money.
So basically, that's that old adage, right? Bet on the jockey and not the horse.
Yes, absolutely. It's just more difficult than people can think because you got time duration risk. Even if you bet on the right jockey in 6 years, he has a medical emergency. You have to really think about that kind of stuff in the space, but it's worth it. It's worth it because this game has made more millionaires than anything else. The message I want to bring, though, is that it's also made more bankruptcies. And it's probably not because everyone's an idiot but you. It's because it's a dangerous game, but it's worth it.
Hunter, thank you so much for being here. We want to be respectful of your time. Can you tell everybody where they can find you and get in touch?
Sure. Just go to raisingcapital.com and check it out. If you want to look at some of the deals we look at in Phoenix or even partner with us as a fund of funds, just go to asymcapital.com. And that last part, I don't typically talk about that, but I'll say, like, if you like the idea of, hey, maybe I should tap into these 10 dentists I know and make some money, I would say, are the market leaders in terms of making that an easy process. So that you want to get 10 dentists together, raise some capital, and do a deal with our background and track record, we make it very easy.
Hunter, thank you so much. Everybody, that's a wrap of the Liquid Lunch Project. We'll catch you on the next episode.
Let's go!